So you're thinking about living in San Diego, but all the headlines, the doom and gloom headlines you're hearing from the media are freaking you out. And you're wondering, is the market going to crash in San Diego? Well, in today's episode, I'm going to get past the headlines, get into the data, and let's talk about what's really going on in the San Diego real estate market so you could decide if it's right for you and for your family. My name is Kyle Whistle with Whistle Realty Group, your guide to living in San Diego. I am one of those few born and raised San Diegans. I've lived here for 20 years of my life. Actually, no, I've been in the business 20 years. Lived here for 40 years. Half my life I've been in the real estate industry. And so I want to share my experience with you and my knowledge and really help you decide if it is the right time for you, if it makes sense for you at all to move to San Diego and to live in this amazing place we call America's finest city. If you're watching the episode today, if you have questions or you want to connect with my team to explore living in San Diego a little bit further, call or text us at the number down below. That'll connect you with my team where we can learn a little bit more about you, your goals, and put a plan in place to help you accomplish those goals. With that said, I'm going to drop my face down because I know that's not what you came here to see. You came here to get some data and to really see what's going on in the market. So let's just attack this head on. I know a lot of real estate agents want to make everything sunshine and rainbows and everything is great, but then you've got the media that's doom and gloom. And I want to kind of try to bridge the gap between the two to show you what's really going on. And so first thing, which you've probably been hearing a lot about in the real estate industry, is mortgage rates have been increasing. And that is 100% true. Here's kind of the data over the last year. You've seen about a year ago, we were seeing rates in the high twos, low threes, and we kind of hovered around there until the beginning of the year. And ever since then, we've been shooting up, where we were sitting here at the turn of the year. We were sitting at rates around low threes, and today we're sitting at rates in the high fives. So rates have jumped, absolutely. And what we've found is historically, for every 1% increase you see in mortgage rate, you see about 10% of your purchasing power get knocked down. So with rates having jumped about 2.5%, 3%, you've seen about 25-30% of buyers' affordability has gone by the wayside just due to this rise in increase rates. And yeah, that's absolutely going to have an effect. I'm sure there's some realtors out there who will hide from that and be like, oh, it's fine. No, come on now. You've definitely seen less buyers in the market. Now, is that such a bad thing? I don't think so. Let me get into some other data here. I want to share some data with you and show you what homes have been selling for. Let's move over here to the center. We've seen, this is a chart that's going to show you the sale price of a home in relation to the list price of a home. And let me share this. Let me go a little bit further out. So you'll see the 100% line right here. For the majority of the last, this goes back to 2004, the majority of the last 18 years, we have hung out under 100%. This means that homes typically sell for less than what they are listed for. When we had the crash back in 08, we saw homes selling for, in February of 08, 89% of what they were listed for. That's a big dip. But as we hit COVID, none of us really knew what COVID was going to do to the real estate market, but it has been an accelerant that has caused prices to increase substantially. A lot of stimulus money came into the market. A lot of people were stuck at home realizing they didn't want to live where they were living and they wanted some change. And so as COVID hit, we had a couple months where we kind of dipped down, and then it's just been almost a rocket ship ever since. And so we've seen home prices, home selling as high as 106.7% of what they were listed for. So that means for quite some time, buyers were paying up to 7% above what homes were listed for. Where historically, we've kind of hovered in this like high 90s. You're having to pay almost 7% above what the home was listed for. That's not good. My degree in economics tells me this is how you end up with a bubble that bursts. This is not sustainable. This cannot go on forever. And so I'm a fan of rates increasing. Now, I apologize if you're thinking about buying. Yes, it did get more expensive for you. But this is not the worst thing in the world, because we've seen That number hit 107. We saw it dip down in May to 105. I believe you're going to continue to see that number pull down, probably getting it close to this 100% range where you're not having to pay 7% above what a home is listed for. I think you're going to get to a point where on average you're paying right about what a home is listed for. That's a good thing. So the negative is your rate's higher. The positive is you don't have to overpay for a home anymore. You also can have contingencies when you buy your home where you can actually get an inspection done, get an appraisal done. If there's repairs that need to be made, you can negotiate those repairs. So albeit the rate's going to be a little bit higher, but you're going to have less competition and you're not going to have to overpay, and you're going to be able to have some contingencies built into your offer to really make sure it's the right home for you. You're not going to have to rush into something. You're not going to have to settle for a crappy home that you don't really want in a crappy neighborhood. You can actually take your time and get back to a little bit more normal again. So I believe you'll see this pull back. This is super unhealthy. This is not sustainable. We cannot have buyers continuing to pay 5, 6, 7% above what homes are listed for. So want to hit that first. Second thing I want to hit, you're seeing the media. Now this is where we can play around with statistics a little bit. The media right now is reporting number of new homes for sale skyrockets. Look at this. I mean, from December to January to February to March to April to May, the number of new listings has substantially increased, right? I mean, it's more than double in May what it was in December. So they're not wrong, right? The media's not wrong when they state that. There's twice as many homes that were listed in May as there were in December. Fact. Now, let's zoom out a little bit. Let's just look over the last, let's just go 5 years. Oh, interesting. Well, we see a big valley here in 2020. Well, look at that. What do you know? In 2020, in December, we were super low, and then we climbed up through May and June and July. Oh, weird. Let's look at 19. Oh, we did the same thing. 18, we did the same thing, right? This is normal. This is not abnormal to have substantially more homes listed in the month of May and June. This is very seasonal. It's very common in San Diego and really all of the country. You tend to see a lot more homes get listed in the spring and summer because why? Because everybody's moving to figure out where they want to live for the following year. With school, typically schools are starting in September or August. You need to be moved into your new home by the time the school year starts, or maybe in a few months before the school year starts. So most people tend to sell their home in the springtime so they can get moved, settle into their new home over the summer, and your kids can start school in the fall. That's just what you do. So yes, the media is correct that the number of homes being listed is up, but the media is missing the point that this happens every single year, because that wouldn't be very fun to report. This is pretty normal, okay? So I think we've squashed that myth. The other thing that I'm hearing a lot from our clients is, well, I'm waiting for the market to crash. Okay, cool. I made a lot of money when the market crashed last time. I don't blame you. So let's take a look at what we call inventory. So what inventory is a relation between how many homes are for sale and how quickly our home's selling. So when we talk about inventory, we're currently sitting at just over a month of inventory. What that means is, let's assume, I think there's about 4,000 homes for sale in San Diego right now. Well, there's about 4,000 homes a month that are selling in San Diego. So if no new homes came on the market, we had 4,000 homes at the start of the month, and we're selling 4,000 homes, all of the homes would sell out in 1 month. That's how you have 1 month of inventory. If we had 8,000 homes for sale and 4,000 were selling a month, we would have 2 months of inventory. If we had 20,000 homes for sale and we were selling 4,000 a month, we would have 5 months of inventory for sale. So that's how you come up with inventory. So when we look at this is another one where media can maybe look at this 1 year chart and they could be like, inventory of homes for sale is increasing. Again, you're not wrong. You're just maybe not looking at the whole picture. Okay. So let's zoom out here to the max chart, which is as far back as our data goes. Oh, that little rise actually doesn't look like a whole lot. We're still historically low when it comes to inventory. What most of our clients are wanting is they want to get home prices to fall so it becomes more affordable. Well, let's look at the last time home prices fell. When was that? Oh yeah, that was in 2007, 2008, 2009. That was when home prices fell. Well, let's look at where was the inventory or the supply of homes for sale. Oh man, it was at like 8, 9, 10, 11, 12, 13% or 13 months of inventory. So that would mean you'd have to have like, what, 52,000 homes for sale and selling 4,000 a month? Like that's what that would relate to. So when we saw home prices fall or crash, if you prefer that word, we were looking at 8, 9, 10, 12 months worth of supply of homes for sale. That's what has to happen. So if we want to get back to that point, we're at 1.1 months. When home prices fell, we were at 8 to 13 months supply of homes for sale. We got a long ways to go before we get to that level, before we get to that crash level. Let's even look back over the last 8 years. You'll see we hovered in this like 4 to 5% range pretty consistently. This is from 2014 through 2019. We hovered in 4% or in the 4-month range. So that would mean just to get back to that level, we would have to increase the supply of homes for sale by 4x. 4 times as many homes for sale just to get back to this 4 to 5 month range. Well, let's look at the actual prices of homes for sale. So we were talking about here in 2014 through 2019. Oh, look, home prices actually went up when we were in that 4 to 5% range or 4 to 5 month range. So 4 to 5 month range, we actually saw home prices appreciating at a much smaller rate than what we've seen recently, but we still saw steady appreciation. The only place where we saw big depreciation was what we talked about in 2007, 2008, when you had 8, 9, 10, 12, 13 months supply of homes for sale. So if you're thinking that because interest rates went up, that we're going to end up in 2007, 2008 again, we got a long ways to go when it comes to inventory, because at the end of the day, home prices are just simply supply and demand. With 1 month supply, and I do believe this will continue to increase. Like, I don't think we're going to stay at 1 month. I think we'll get up to 2, 3, maybe even 4 months of inventory. But even getting back up to 4 months of inventory, that was still an appreciating market, albeit more moderate appreciation. But we were still in an appreciating market. To be in a depreciating market, last time we saw big depreciation, we were at 8 to 13 months of inventory. We are so far away from that it's ridiculous to think the same thing is going to happen again. Also, the reason that we had the crazy crash and prices fall was I got a loan when I was scooping popcorn at a movie theater, and they gave me a loan for a $500,000 house that I probably should have never been able to buy. Like, that was dumb, right? You didn't have to prove your income or anything. They're just giving loans out like candy. That has not happened since 2007, 2008. Majority of people have 20, 30, 40% equity in their homes right now. People are sitting pretty. So we're not going to see the same thing all over again. For any of the media that's out there trying to convince you otherwise, I think they're full of crap. And this is the data to prove it. I'm not somebody, I don't want to come at you with opinions. I'm just going to give you the data, okay? So I believe we'll see inventory increase from this 1.1 month we're sitting at. 2 months, 3 months, maybe 4 months of inventory. But I think that's a good thing, because what that'll do is that'll get us back to where we just have this nice stable appreciation. Because what we've seen since COVID, this hyper appreciation, this is not stable, right? We can't sustain this for a long period of time. That's how we can end up in a situation where you do have a bubble that bursts. And so I'm personally a little bit happy that rates have gone up, because we need to slow things back down. This is crazy. This is not good. Let's slow it back down a little bit. I'm sorry if the interest rates knocked you out of the market. But with that said, I do have some insider info. So let me pop back on the screen here. So one of the cool things about working with our team at Whistle Realty Group is we're kind of on the inside track. We're not just trying to do the same thing that everybody else is. We're trying to find opportunities for you to really capitalize on the market and do things that most people don't know about. I've got lenders right now who can do mortgages in the 3% range. Literally, as of today, it's June 27th, I'm recording this. I got a lender who can get you a loan at 3.00% today. So here's what's great is if you're comparing today to 3 months ago, where you could have got a lower rate. Well, guess what? 3 months ago, you had to pay way over the list price. You couldn't ask for an inspection contingency and appraisal contingency. You couldn't ask for repairs. Like, it was insane. Today, you can get all of those things you couldn't get then, but I could still get you a rate at 3%. So if you want to explore living in San Diego further, you want to capitalize on this new market where some of your competition is out of the way, could still get you that low rate and actually be able to have some contingencies, pick the home you want. Like, this is actually a blessing in disguise because everybody else is crying about rates in the 5s and 6s. I got the inside track. I can get your rate at 3%. So if you want to get dialed in with that, call or text the number down below, connect you with my team, and tell you exactly how we make that happen. And if you enjoyed this video, hit the thumbs up button. Let YouTube know you enjoyed it. Throw a question in the comment section if you have one. And if you want more of our content, you can hit the thumbs up, or I'm sorry, hit the subscribe button and the little notification bell, and YouTube will take care of the rest. With that said, I'm Kyle Whissel with Whissel Realty Group, your guide to living in San Diego. Thanks for tuning in.